Introduction to Accounting and Business Part 2. We're going to state the accounting equation and define each element of the equation. The resources owned by a business are its assets. Assets can be cash, accounts receivable, land, automobiles, supplies, inventory, things that are owned by the company. The rights of creditors are the debts of the company. They're called liabilities. This can be accounts payable, unearned rent, mortgages payable. Anything with the word payable, anything with the word unearned is considered to be the liabilities. The rights of the owners are called owner's equity. The equation for accounting is assets equal liabilities plus owner's equity. Assets, resources owned by business, equals the liabilities, the rights of the creditors, plus the owner's equity, the rights of the owners. So let's take an example. I like to look at this a little more differently, kind of give you a visual of what this looks like. Here's a pie. Let's say this is a pie that we want to eat, but we have to see how much of this pie we actually own. So there's assets, $45,000. Liabilities are $15,000, and the owner actually has rights and owns $25,000 of this piece of pie. So the pie together, over here is what the company owns. We still owe $15,000 associated with some of these assets. So the owner can only have this piece of the pie right now. Once the liabilities are paid off, he can have the whole pie because he owns all of it. But for right now, he doesn't own all of it. He only owns his little piece of it. That's kind of how I want you to think of owner's equity. Assets equal owner's equity plus the liabilities. Now we're going to talk about how business transactions can be recorded in terms of the resulting change in the elements of the accounting equation. This is really like a prelude to Chapter 2. So all I'm really doing here is explaining what happens in each transaction in the different accounts that affects the transactions, and that's to help you start thinking about what these transactions mean and how they're actually going to be recorded later on in a journal. Now, a business transaction is an economic event or condition that directly changes an entity's financial condition or its results of the operations. So for instance, on November 1st, Chris Clark deposited $25,000 in a bank in the account name of Net Solutions. So he took cash and he put it in the bank. And anytime an owner puts an investment in the company, it goes to his capital account. So Chris Clark now has a capital account that has $25,000 in it, plus the cash account has $25,000 in it. I want you to think, for the purposes of accounting in this particular class, we're going to talk about the checking account as if it's a cash account. But most companies do not have obscene amounts of cash laying around. They're really referring to the checking account at the bank. Now, November 5th, Net Solutions paid $20,000 for the purchase of land as a future building site. So we're going to take $20,000 for cash, and then we're going to create a land account, and we're going to put $20,000 in it. We balance the cash account to come out to $5,000. So we now have $5,000 in cash. We have land of $20,000. Together makes $25,000, and that equals the equity in the company, $25,000. So the owner has basically $25,000 leverage on the $25,000 assets. See, he owns it all. All of this is his. On November 10th, Net Solutions purchased supplies for $13.50 and agreed to pay the supplier in the near future. Anytime we talk about paying somebody later, we create what's called accounts payable, which is a liability. We go ahead and list it as an asset, but we also owe against it. So we have cash for $5,000. We create the supplies account and put $13.50 in it, and we still have our land of $20,000. So together our assets equal $26,350. We now have accounts payable of $1,350, and we still, as the owner, have leverage of $25,000 against the $26,350 worth of assets. The liability created by a purchase on account is called accounts payable. This can be worded as purchase on account, agreed to pay in a future date. Items such as supplies that will be used in the business in the future are called prepaid expenses, which are considered to be assets. So I want you to think of supplies on the same manner as what we talked about, or what we will talk about in prepaid insurance. Prepaid insurance is another prepaid expense, and we call these assets. Don't get caught up in the word expense. What you need to be paying attention to is the prepaid word. Prepaid indicates it is an asset. Now, on November 18th, Net Solutions received cash of $7,500 for providing services to customers. A business earns money by selling goods or services to its customers, and this is called revenue. We got $7,500 in cash. Now we have a balance of $12,500. We still have supplies. We still have land. We still owe the money on accounts payable. Mr. Clark still has his $25,000 in equity. And now we have revenue, which we'll call fees earned, $7,500. Our equation is balanced. Our assets equal our liabilities plus our owner's equity. Revenue from providing services recorded as fees earned. Now, it can be called revenue, it can be called fees earned, it can be called income. Don't get caught up on fees earned. It really is revenue. It is income. And out in the real world, we refer to it as revenue and income. Revenue from the sale of merchandise is recorded as sales. We'll talk about this in Chapter 6. Other examples of revenue include rent, which is recorded as rent revenue, and interest, which is recorded as interest revenue. An account receivable is a claim against a customer, which is an asset. So if you do work for a customer and they want to pay you later, it is considered to be accounts receivable. Accounts receivable is not revenue. Now, during the month, Net Solutions spent cash or used up other assets in earning revenue. Assets used in this process of earning revenue are called expenses. Now, on November 30th, Net Solutions paid the following expenses: wages, rent, utilities, and miscellaneous expenses. Together, these expenses cost $3,650, so we're going to take that amount out of cash, leaving us with a balance of $8,850. And we're going to record the wages, rent, utilities, and miscellaneous expense as a negative against the owner's equity. These are considered to be equity accounts, but they have an opposite effect. Capital increases, fees earned increase, expenses decrease equity. So we will list these as negative amounts. Our equation is balanced. On November 30th, Net Solutions paid creditors on account $950. So what we're going to do is we're going to start paying on accounts payable here. So when we say paid creditors on account, that means that we're going to pay off part of the accounts payable. So we're going to take $950 from cash, leaving us with a balance of $7,900, and we're going to take away accounts payable, $950, leaving us with a balance of $400. We are in balance. Assets equal liabilities plus the owner's equity. On November 30th, Chris Clark determined that the cost of supplies on hand at the end of the period was $550. Now, when we bought the supplies, we recorded them as assets. Throughout the month, we've used some of these assets. And so what we did is we had somebody go count the assets or the supplies that were on hand, and we determined they were $550 left, meaning that we used $800 worth of supplies. So we're going to take $800 out of the supplies account, leaving us with $550, and we're going to create the account called supplies expense and list it as a negative $800. So now supplies expense represents $800 and supplies Thus, the asset is now $550. On November 30th, Chris Clark withdrew $2,000 from Net Solutions for personal use. We take $2,000 from cash, leaving us with $5,900. We create the drawing account and list it as $2,000. Our account is balanced. Assets equal liabilities plus owner's equity. Now here's a summary of all of these transactions, A through H, and here's the balances of all the accounts listed below. Balance in cash is $5,900, supplies is $550, land is $20,000, accounts payables $400, Chris Clark capital is $25,000, the drawing account is $2,000, we earned $7,500 in revenue, and then we had wages, rent, supplies, utilities, and miscellaneous expenses. In part 3, we're actually going to talk about the financial statements, but I kind of want to give you a prelude to this. We're going to talk about the income statement. The income statement has fees earned minus expenses. So revenue minus expenses equals the net income. So these accounts here will be the ones that are listed on the income statement. We will then talk about the owner's equity account, or the owner's equity statement. That is the capital and the drawing. And then we'll do the balance sheet, which is assets and liability, and also the capital.